Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to InvesTips from the CIO's desk. I'm Steve Brice and your host. Today I want to talk about something that might sound a bit surprising. Why being an average investor might actually be your best strategy and result in you being better than average. Now think about this. Most of us grow up hearing that we should always aim to be better than average in school, in our careers, and in life. But when it comes to investing, trying to be above average can actually work against you. Let's start with a simple idea. Most people believe they're better than average at things like driving. But mathematically, of course, that can't be true for everyone. And the same thing happens in investing. We tend to remember our good investment decisions, we forget or downplay our mistakes, and believe that we can beat the market. And this is called overconfidence bias. And it can lead to taking on too much risk or trading too often or putting too much money into a few ideas. And over time, these behaviors can really undermine returns. Now, most investors will try to outperform the market in two ways. So the first one is trying to pick the right stocks. And the second one is trying to time when to buy and sell investments. Now, I guess this sounds reasonable, right? But here's the reality. Even professional fund managers whose full-time job it is to beat the market struggle to do so consistently. In fact, most of them actually underperform the market over time. And timing the market, well, that's actually even harder. So let me give you an example. If you invested $10,000 into the US stock market and stayed invested over 20 years, it could grow to around $72,000, so more than 7 times the initial investment. But if you missed just a handful of the best performing days, your returns would be cut by more than a half. So trying to jump in and out at the right time can actually cost you a lot and be very risky in terms of achieving your financial goals. So here's the key idea. The most successful investors are not the ones who make the smartest trades. They're the ones who stay disciplined and let compounding do the work, i.e. they get and harness the average of market performance. So compounding simply means your returns earn returns, and those returns keep building over time. Now, it doesn't look exciting day by day, or even actually over the years, but once you get to decades, it's incredibly powerful. So here's the big takeaway. Investors who try too hard to outperform often end up underperforming and doing worse, while those who stick to a steady, average approach often come out ahead of other investors. So in investing, average isn't mediocre. It's actually a winning strategy. So next time you feel the urge to chase the next big opportunity or try to time the market perfectly, just pause and remember. Sometimes the smartest move is simply consistently to invest in a diversified portfolio, regardless of the headlines of the day. Thank you for listening to InvesTips from the CIO's desk. I hope you found this useful and interesting, and I wish you all the very best on your financial journey.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.